Hello and welcome. In October 2025, something remarkable happened in Singapore's stock market. The main benchmark, the Straits Times Index, didn't just climb, it soared past a major psychological barrier to hit new all-time highs. Today, we're going to unpack the story behind the numbers, explore which sectors are leading the charge, and look at what this resilience means for the road ahead. Disclaimer: this video is created purely for educational purposes only. It is not financial advice and should not be considered as a recommendation to buy, sell, or hold any investment. Please conduct your own research or consult a licensed financial advisor before making investment decisions. The big headline in October 2025 was the Straits Times Index, or STI, decisively breaking through the 4,400 point level, peaking at over 4,470 on October 7th. This pushed the market's total return for the year to an impressive 20%. But what's really interesting is why this happened. This isn't just a story about numbers on a chart. It's a story about a surprisingly resilient economy. Let's start with the macroeconomic picture. Singapore's economy has been consistently outperforming expectations. In the third quarter of 2025, it grew by 2.9% compared to the previous year, which was significantly better than what most analysts had predicted. This strong performance, especially in the face of global trade headwinds, provided a solid foundation for corporate earnings. Adding to this stability is the Monetary Authority of Singapore, or MAS. In its October statement, the MAS decided to maintain its policy of a modest and gradual appreciation of the Singapore dollar. For investors, this signals predictability and stability, two things that are highly valued. And then there's inflation. While other parts of the world have been battling rising prices, Singapore's core inflation has remained remarkably low, averaging around just 0.5% for 2025. This has allowed interest rates, like the Singapore Overnight Rate Average, or SORA, to stay relatively low, creating what some might call a Goldilocks scenario. Growth is strong, but inflation isn't overheating. Now, to understand the market's rally, you have to look at its engine room, the financial sector. Singapore's three major banks, DBS, UOB, and OCBC, are the bedrock of the STI. Together, they make up about half of the index's total weight. So when the banks do well, the entire market gets a powerful lift. DBS, the largest of the three, saw its shares surge to a new all-time high. And as a group, the banks attracted the highest amount of net institutional investment in early October. Their strong profits and attractive dividend yields have made them a magnet for capital. But this heavy concentration is also a key risk. Because the banks are so dominant, any specific challenges they face could have a disproportionately large impact on the entire index. Beyond the banks, we're seeing a fascinating story of strategic repositioning, especially in the real estate investment trust, or REIT sector. A clear divide is emerging between what we can call new economy assets and old economy assets. On one side, you have REITs like Keppel DC REIT, which focuses on data centers. Fueled by the global boom in artificial intelligence, it delivered a nearly 13% year-on-year increase in its distributions to unit holders for the first half of the year. On the other side, REITs holding traditional office buildings are facing headwinds from trends like remote work. In response, they are making bold moves. Keppel REIT, for example, recently made its first ever acquisition in the retail sector to diversify its income. Meanwhile, Lend-Lease Global Commercial REIT sold off the office component of one of its properties to pay down debt. These moves show that the REIT sector is no longer a simple yield play, it's about strategic adaptation. The industrial sector has also been a source of incredible growth. The standout performer here has been ST Engineering. Its stock price surged over 90% year-to-date, driven by strong performance in its defense and public security division amid a global rise in defense spending. But the most compelling part of its story is its massive order book, which stands at over 31 billion Singapore dollars. This provides exceptional visibility into its future earnings, making it a favorite among investors. We're also seeing compelling turnaround and transformation stories. DFI Retail Group has seen its stock perform remarkably well thanks to a recovery in Asian retail and smart cost restructuring. And in telecommunications, Singtel is successfully pivoting from a traditional telco into a digital infrastructure powerhouse, focusing on building out data centers to meet the surging demand from the AI revolution. So, where's the money flowing? The data shows that institutional investors, often called the smart money, are being very selective. In early October, funds flowed heavily into the big banks and key industrial players like ST Engineering. At the same time, we're seeing confident signals from corporations themselves. Several companies have been buying back their own shares, a classic sign that management believes their stock is undervalued. OCBC, for instance, was a prominent buyer of its own stock. This, combined with a revitalized IPO market, suggests that confidence in the market's long-term health is growing. Of course, no market is without risks. As a trade-dependent nation, Singapore remains sensitive to external shocks, like a slowdown in global growth or unexpected economic data from the United States. The market has had a strong run, and as valuations get richer, we can expect to see more volatility. So, to bring it all together, what does this tell us? The record-breaking rally of the Singapore stock market in October 2025 is not built on sand. It's anchored in a resilient domestic economy, a stable policy environment, and the stellar performance of its blue-chip companies. The market's momentum has been powered by the financial strength of the three major banks and impressive secular growth in key industrial sectors. Looking ahead, the key themes to watch are the strategic shifts within the real estate sector and the ongoing digital transformation of Singapore's corporate giants. While the outlook remains positive, the market's heavy concentration in the banking sector and its sensitivity to global events are important risks to keep in mind. The story of Singapore's market is one of resilience, adaptation, and a highly selective pursuit of quality. If you found this analysis helpful, please give this video a thumbs up, share it with others, and don't forget to subscribe for more insights into the markets. Thank you for watching.